Hello, everyone, and welcome back to another episode of WagMe TV. Episode 20, the big 2-0 today, coming to you live on CPI Wednesday.
Big day.
Definitely a big day in the markets today. Everyone was looking at this, trying to figure out what's going on. We're going to cover it all today. As always, joined by the absolute homies. We got the All-American, Ev Smith.
Yes, sir.
We got the NFT Lord, Alex Garcia. And we got the Doctor, Doc Mata. How we doing, fellas? How we doing? We got a little cheers.
Doing great.
Well, at least I've kind of become numb to my portfolio being worth nothing. So that's the bright side about all this stuff. So
trials and tribulations of a bear market.
Yeah, bear market, but we're still here grinding, for the fans. Thanks for tuning in as always. You know how it goes. So yeah,
feel free to like and comment below. I feel like we don't get enough of that, so would love some attention from the fans.
Yeah, let us know your thoughts.
Yeah.
And it's like we see you watching.
So guys, like crazy day today. CPI came in at a strong 9.1%. Expectations are at 8.8, so exceeded expectations. Obviously a very elevated print. Everyone was looking at it, looking forward to it, trying to figure out kind of what's going on the inflation side, trying to get a read on what the Fed is going to do next. What do you guys see is kind of what you guys are looking at in the market? How are you guys feeling about it? Just broadly, what do you guys think of those CPI numbers today?
Yeah, I think not necessarily par for the course, because that would have been 8.8. But I think, in terms of like where we expected that inflation to come from, par for the course, right? I think we expected it was going to be heavy energy. Obviously we expected food to go up a little bit, but you can see that, in terms of where that 9.1 is really being heavily weighted, it's in this energy category. And we're seeing a lot of, 60% inflation amongst energy commodities, and then 19.4% amongst energy services. So not necessarily a unique issue to the US, but as we discussed like before hopping on here, the US is kind of, USDC is still the reserve currency. So it's like, given that that's the case, a lot of people are kind of watching what we're going to be doing with our monetary policy. But I think in terms of where we expected the actual inflation to come from, I think energy was pretty much on par.
Yeah, and it was kind of mixed signals, because I know we saw a higher CPI number than what we were expecting. We got 9.1, we were expecting 8.8. But the core was actually lower and hit the 6-month low that we saw. So this is core CPI. So just a reminder, that doesn't include food and energy, which if you looked at Sia's graphs in the last screen share right there, those were easily the highest indicators or additions to inflation. So this is core, non-food, non-energy. And we saw in January core hitting 6 exactly. And then we kind of went up to a 6.5, and since what is that, March, we've been moving down from there. So I think we were expected to be around 5.7, 5.8. We hit 5.9, but it was still a decrease from last month, and then also 2 months ago. So yeah, I think the big headlines of this CPI print were just how expensive food and energy have become, not only in America, but around the world. I think we're seeing those figures in other economies as well. But definitely huge factors in the CPI print that we saw today.
Yeah, that's a great point out right there in terms of the core CPI figure. I think when you look at the market reaction that we saw today, I think that actually could explain kind of what's going on. Obviously on a huge CPI print overall that we saw today, you'd kind of expect like a pretty decent sell-off here. Expectations for like 100 bip rate hike this month for the Fed definitely went up. And so you would expect, kind of to see a pretty decent sell-off. But we actually saw some resiliency in the market, both on the crypto side. We kind of saw a quick dip right when the print was released in both Bitcoin and Ethereum. But you saw a really quick kind of bounce back, right? And then maybe even a little bit of a rally. Same thing on the dollar index side. Like, we pay attention to DXY a lot. You saw kind of a steep jump upwards, but by the end of the day, we were actually, back in the territory that we kind of started. And I think that's, people are kind of reading through here and expecting that inflation number, particularly on the energy and food side, to kind of come down here over the next couple of months, possibly. I think we discussed it in last week's episode, but we have seen a material sell-off in commodity prices, whether that's oil or iron or, even wheat, copper. A lot of these commodities have sold off significantly from their highs, maybe a month and a half ago. And so I think the market almost just looking ahead, basically betting on the fact that this could be kind of an inflation top. And really glad you pointed out those core numbers, because the core without food and energy has been dropping. So market kind of looking ahead, expecting, I think, for this to kind of be the peak. But yeah, I guess we're kind of gonna have to see where we go from here. Yeah, that's a great chart for oil.
Oh, interesting. It dropped below 100.
Yeah, and I think that's also why we saw a little bit of resilience today, as well, because some of these other key pieces that we're watching, right? I know that Dixie had some resistance as well, right? And so I think it's just kind of typically they're a little bit inverse here moving forward. I guess the real question is a main reason is, has inflation peaked, right? And that's what everyone's kind of saying is inflation's peaked. We're going to start to, see this go down from here. But if I remember correctly, last month, everyone was saying inflation peaked too. So with a grain of salt, right? It's like, where are we actually, what do people actually know? Fed's raising interest rates, maybe 100 bips, but we talk about this every week. It's really the supply side that's kind of a big factor here. So, honestly, there's these big gray clouds from a macro perspective, and I don't necessarily see them getting any better. This is starting to move really heavily into Europe. And we're just seeing a lot of, tough things going on geopolitically. So could be interesting to see how that goes. I thought it was interesting. Usually when, like Soham mentioned, right? Usually when we have a specific expected rate, if we go over that, we see a pretty nice tank. And it almost feels like this was like a little bit of a surge of like disbelief. Like, okay, like this is the last time it's going to happen. Next time it's going to be expected or lower. And so it should be interesting to see what that does to the market and how that flushes that out over the next couple of months. Should it not be the top? I'd be really interested to see if we see like an even more drastic tank because of that. But I don't know your thoughts on that, if it's peaked or where you all are at on that. But that's what I've been hearing in the Twitterverse.
Well, I think a nice add-on to that is something that was in the Wall Street Journal today, which was really just a calculator for how your lifestyle is affected by the current inflation, which I think is really important, just understanding how everyday consumers get hit by this stuff that we're talking about every week. But in previous episodes, we've talked about how October is really a big year for us, or a big month for us, to determine this year over year and really seeing how strong this inflation is and how consistent it could be down the road, from today to a year, months from now. So June, July, we hit that, we were right around that 5.3, 5.4. And when we went to October, that's when we saw that 6.2, that 50 basis point hike in CPI. And as we went through, we saw November, December gradually growing all the way up to June that we're at. So, I think, like we've talked about in previous episodes, these are all very important numbers. But when we hit that October gap that we see that we're seeing here, it's going to be a big indicator of, how long this stuff could last, and how, just entrenched these different factors in inflation are.
Absolutely. And when we think about like your average day consumer kind of around the world, right? And what they're most impacted by, it really is like energy and food, right? Two of the biggest kind of costs that any household really incurs. And we have kind of seen a lot of like kind of global turmoil kind of developing. I know we've talked about it in the past in terms of expecting food shortages and things like that to potentially start hitting some of these emerging market countries. And I think we're kind of seeing a lot of that unrest kind of develop here, which is definitely sad to see. Did you guys have some of those articles pulled up?
I think one thing that would be helpful to touch on, and I think it goes really well, and I was about to share this while you were talking, but I think it goes really well with what you were saying there, Sam, is this UMich consumer sentiment chart right here. And so really as a whole, it's just a perspective of how the world's feeling right now, and how each of the consumers are being impacted by this. I mean, if you look at this, I mean, we're at an all-time low. I mean, debatably, right? I can't quite tell with 08, but we're very, very close, and we've clearly dropped below here in 2012. So it's not looking super great from this perspective. I mean, it's definitely on the lower range. So it just kind of gives perspective into just how the world is feeling about all of this right now. And it's definitely not typically a good sign when this is low for any sort of risk on assets, especially something like a Bitcoin, right? So
yeah. And I think another key point here before we kind of go into what Zoe was hinting was, the US dollar is at its strongest it's been in years. And it's something where one of the best assets that you can hold at the moment is the US dollar and the strength that it has compared to other, major currencies. When you look at how the Fed is increasing rates and talked about quantitative tightening compared to the European Central Bank or the Japanese Central Bank, or other central banks around the world. And that could be a big reason behind, inflation continuing in the food and energy areas where consumers want to hold on to their dollars, because we're seeing that dollar continuously bring more strength to it. So I think you were probably hinting at something else with your point.
Well, to Zoe's point and to your point, Ev, the US dollar and the euro hit even parity for the first time since 02, which, obviously means several things, in terms of like the strength of the US dollar, like that's pretty incredible. I mean, basically every time you travel to Europe, you're paying a premium to go over there, and like you're paying a premium to participate in their market. But now obviously the US basically has the same parity as the euro, which is interesting. And then from a kind of, more like worldwide turmoil standpoint, Sri Lanka basically essentially declared bankruptcy this past week, or maybe a couple of weeks ago at this point. And, their prime minister had warned of, crisis through the entire year of 2023. He was actually overthrown in like an insane riot, and they stormed the capital, and all the people basically overthrew him. He resigned. But some of like the worry about this is a lot of the food shortages hit them really, really hard. So 80% of their population at the time of this overthrow were skipping meals to deal with their food shortages of what they were importing. And they're expecting their economy to shrink by 7%. And they said that inflation could climb above 60% for the Sri Lankan currency. So just a lot going on in terms of like more kind of, third world effect or second world effect. But at the same time, obviously that's going to have cascading effects like into like the Netherlands with what we've seen, and some other countries as well.
Yeah, absolutely. Just really tough. Like anytime, us in the US are obviously like feeling it, in our pocketbooks and our bank accounts when it comes to inflation. The folks in kind of the developing nations, emerging markets, things like that, they're when they're much more import driven when it comes to, you know, their food supply and things like that. Country like Sri Lanka clearly doesn't have like a whole lot of land in order to, you know, feed their entire population. You know, they're feeling it extremely hard. So definitely something to keep an eye on. You know, I think we've touched on it before in terms of the food shortage situation, but definitely something to, you know, keep a pulse on and stuff moving forward.
Yeah. And I think it was something that we talked about with Ukraine in a previous episode, where it's really, you know, a question when we talk about supply side and how supply side has been struggling. And while our tools are demand side, we can't fix the supply side. These are problems coming from the exports of these nations that have either been hit by, you know, crisis like Ukraine, or supply shortages, or supply chain backups, you know, in other areas of the world. And it's an idea of that in the US, we're able to create a lot of the food that we eat, or, you know, import from other nations that have strong supply chains, that have strong economies, because we rely on them. In some of these developing nations, you know, they're pulling from a lot of different economies, and they're dependent on that. And that's something where, you know, you look at North Africa, and they're pulling their wheat, grain, different their resources from Ukraine. They're going to be heavily affected by the next cycle of food coming from Ukraine. And so this is something where I think we could probably look into Sri Lanka and look at who the suppliers are there, and, you know, how this could have happened, you know, 6 months to a year ago, because, you know, there's this event, but there's also the lead up to it and how this occurred. And so I think that's something we could dive deeper into.
Yeah, no, absolutely. You know, on the kind of topic of the inflation, obviously the big print today, does anybody have like a Bitcoin chart kind of pulled up here that we might be able to kind of go through, look at kind of what's going on from kind of a technical perspective? You know, the question is always like, I think a lot of people are waiting to have that, like, you know, severe drawdown, you know, to get us into a buy zone. But we are holding this 20K pretty steady right now. And, you know, with today's inflation print, I personally thought that, you know, we could get dragged below 20K. We did maybe for like a second, but pretty resilient bounce back. So I don't know, Sia, if you have a little bit of a, you know, technical perspective on what we can kind of look for and expect, that might be helpful.
Yeah, I think just for a little bit of context, I think we talked about this in the last video, but this line represents when the next FOMC meeting is. So the next time they could raise rates. So we were talking about how, like, you know, maybe there's some room to like get a little bit of a run here, right? Like there's really no resistance until, you know, 25, 23K around there, maybe this aspect here, maybe around 23K. But at the same time, like, short term, yes, we might have a chance to, like, you know, get up into the mid 20s, but I think longer term, midterm, I don't see us staying above like that 20K support for too long. Like I think we still have some more pain to come, but obviously it really depends on you know, what's going on macro wise. And then also, you know, obviously if for some reason we see DXY capitulate and more demand comes into Bitcoin, you know, just like extraneous factors like that. But if that does happen, if we do see a capitulation, like I would expect us to play down here somewhere, like between, you know, 18, 17, and then like 12 and a half or so, because that's what our last big support was previously. So in terms of like, if you're really thinking long-term, you know, Bitcoin theoretically is undervalued right now, but if you're talking about the next 6 months, year, like we could definitely go lower. But historically speaking, Bitcoin hasn't been this undervalued since the last bear market. So obviously, like to your point, we've held this way stronger than I think a lot of people would have expected. I think a lot of people at this downturn expected us to drop through and then maybe see that like action down in here before that hike. But we've held it really strong to your point. So it's really, really interesting because like a triple bottom, which what we're seeing right now is technically a bullish technical like pattern. Doesn't mean it always plays out, but 9 times out of 10, you get a little bit of an upside movement where the target would be above that resistance channel. So that would be above 22.4, 22.3. But it really is hard to tell right now because macro seems so ugly, but at the same time, like you said, Zoe, we're holding that support really well.
Very interesting. Very interesting. And, you know, on the side of the rates too, we did see, I think, just very recently an inversion in like the twos, tens. Historically, you know, people view this as a, you know, recession indicator. It's not that every time that this happens, a recession happens, but every time a recession has happened, the twos, tens have inverted beforehand, right? So anytime it does happen, people like to kind of keep an eye on it. From my understanding, you do need to watch it for more than just a little bit, right? The longer it stays inverted, the higher percentage chance that we do end up in a recession. So for example, if we end up having a twos, tens inverted for weeks on weeks, maybe even a month to 2 months, that's a pretty strong indicator, right? We have seen it in the past though, you know, invert temporarily, and that hasn't necessarily, you know, been a recession indicator. So something to definitely keep an eye on. Something that we noticed kind of recently here. Yeah. What's up?
So what does that kind of indicate? Like when you look at the 2 and 10 year, what is that almost conveying to somebody that's coming into this new, or, you know, doesn't have experience with what the 2 and 10 year rates are?
For sure. Basically what that means is the market is pricing in a short-term rate increase, but at the same time, the market is pricing in long-term rates actually coming down. So what you're seeing here is basically like, okay, the Fed is going to increase rates in the short term, but we're also expecting them to cut rates pretty significantly in the medium to long term, right? And that would indicate, you know, they're raising rates right now, but they're probably off on where the market actually is. And they're probably going to raise rates to a point that would cause, you know, an economic recession, in which case they would have to cut rates, you know, further down the line. And so that's kind of what that's signaling.
That long-term rate being lower is that rate cut in a recession where they want dollars to flow easier, and so they're going to lower the rates that they have at the moment.
Yeah, exactly.
Gotcha.
Exactly. It's basically saying in the short term, the Fed's going to increase rates because, you know, they think the economy is strong and like they need to battle inflation and this, like those sorts of things. In the medium to long term, they're actually like, you know, those rates are actually going to be lower than, you know, what's expected, because the Fed will have to kind of step in, cut rates, increase, you know, the circulation of money into the economy, the ease of credit access, things like that, to try to spur the economy back up from, you know, a recession.
Right. Yeah, no, that's super helpful. And I think that's something that we've talked about in the past where, you know, in small circumstances, like small time circumstances, it's not too much of a big deal. But when you see that curve inversion for extended periods of time, that's when people consider it an indicator. And that's when you should kind of, you know, be worried a little bit about that. Motto, what do you have here?
Yeah, so the top here is just the 2-year yield and then the 10-year yield, where I thought this was a cool chart because they actually broke it down in the bottom here, based on what that spread looks like. So you can really see when that inversion happened. So we did see one here in April. And like Soham mentioned, right, it really is only an indicator when it holds for a while, right? And so that's why we should really keep our eye on this. It touched here in June briefly, and now we're quite clearly under, right? And so I'll be keeping a brief eye on this as well. I think it's something that a lot of people are looking at just because it has been that recession indicator in the past. So yeah, just another indicator pointing towards not the greatest macro news, but yeah, definitely something to look into.
Very interesting. And yeah, all things macro, I think we're all four of us are very in tune and keeping an eye on everything that's going on. So between the four of us, hopefully we can keep all our listeners up to date on, the latest macro trends and kind of what we're seeing in the market there.
Yeah, and one last thing. I know we do this every week, so I wanted to stay consistent with it. Is James Butterfield's
Oh yeah, absolutely.
Our
digital
man.
asset fund flow. Yeah, our man. So this is from July 11th, so about 2 days back. We saw a little bit of an inflow, pretty minor inflow. Here, again, this is all institutional buyers, flows by the asset, flows by the provider. But this is really where we want to focus most of our eyes, I would say. And so Bitcoin, once again, a little bit down. Still has a positive year-to-date flow, still has just under 1 million for the month-to-date flow as well. But what's interesting is it seems like institutions are getting a little bit more bullish on Ethereum, right? We saw massive outflows out of Ethereum over the course of the year. I think it was 11 weeks straight. And so kind of good to see that coming back in. I'd be interested to hear, is it the proof of stake piece? Is it something else that's going on in the background? I don't know. I haven't heard any super recent news on it. So I was curious if you all had any input on that. But kind of just another look at to what some of these institutions are doing. Again, not a massive amount into the short of Bitcoin either. So I think a lot of institutions are kind of just waiting on the sidelines and going to try to wait out some of this uncertainty. But any thoughts here, fellas?
Yeah, Mata, would you mind zooming in on that a little bit?
Yes.
But the second on the Ethereum front is that I believe in the last week or two, their second testnet was approved for ETH 2.0. So I think in recent weeks, we've talked about how Rinkeby was that first testnet that was able to be confirmed for 2.0 and be used by developers. We saw a second one this week. I don't know if that's a reason behind these inflows, but you're starting to see, we saw in weeks past where there was a lot of lead up to the merge and there weren't any test nets ready to go for the developers to hop on and feel confident being on the ETH 2.0 infrastructure. This is the second. There's more test nets to, merge onto this platform, but it's a good sign to say, hey, we're seeing progress and major progress in the transfer to ETH 2.0. It's not some small thing to be able to merge on a test net and make sure that it's, fully approved for development. So definitely good signs on the Ethereum front.
Yeah, I think one thing, that's a very good point. I agree with that. I think one thing that now that I'm looking at this stands out to me is a potential pair trade that's going on here, where it seems like maybe based on this information, there could be a long Ethereum, short Bitcoin pair trade. And so the reason why you would put that on is because you want to remain generally market neutral, meaning that regardless of kind of where the market goes, you are neutral, but you're basically betting that one asset will outperform the other, regardless of market circumstance, right? And so that's why, you see an inflow into Ethereum, and you also see an inflow, the second largest inflow, into a short Bitcoin position, right? And so this pair trade would basically be signaling, okay, regardless of the market movement, if we're going up, if we're going down, what have you, this position, if it was a pair trade, would be betting on the fact that Ethereum would outperform Bitcoin. And if you did put on that pair trade and Ethereum did outperform in any circumstance, whether the broader market goes down or it goes up, you are, net making money. And so just by looking at that's what kind of stood out to me right here.
And so Zoe, does that bank on the fact that Ethereum is more volatile than Bitcoin? And so in a market where all boats are rising, Ethereum's going to rise faster than Bitcoin. Is that my understanding?
So it that would make like this strategy would make money under that circumstance. It would also make money under the circumstance that the broader market, aka Bitcoin and all crypto, falls. This is basically would still make money if you were in that delta neutral, basically pair trade, where even if Bitcoin fell and Ethereum fell, if Ethereum fell less than Bitcoin, percentage wise, you would still be in the money
because of the short Bitcoin that you have there.
Exactly. Yeah.
Makes
so you'd be
sense.
making money on the way down from the short Bitcoin position. And as long as Ethereum outperformed Bitcoin on a percentage basis, you'd still be in the money on the trade.
Right. That makes sense.
It's great analysis. I didn't even see that. That's really cool. That could definitely be a possibility, especially with some bullish news, it sounds like, from Ethereum as well.
I mean, you talked about it, Mata. It's a trader's market. This is something that, you know, I think Soham, the trading experience, is probably the only one he's the only one that's going to see that out of us. So that's great catch, Zoe.
Yeah, we just got diamond hands over here.
Right.
Just
sticking through it.
Yeah, you see it a lot in highly correlated assets. You see it a lot, like in my experience, I've seen it a lot in like the big tech space, where like you could go in the FANG stocks, it used to be really popular back when I was working on the trading desk and stuff, where you would say, okay, I'm gonna go long like two basically two correlated assets, let's say like Facebook and Google, right? It's like, I think that Google will outperform Facebook in any market environment. And so I'm going to go long Facebook and short Google. And basically what that does is it takes the market, generally what happens in the market, you remain neutral and you make money on the position as long as one stock outperforms the other. So definitely something to keep an eye on. I just noticed that when you pull that up. So we'll have to see. Maybe the institutions are on to something. So
yeah, we'll check it next week. Don't you worry.
See, I think you might be muted here. No, the roadie might be out. But what I will say is I think we had other stuff around correlated like assets, right, Zoe? And maybe we can switch into that.
Yeah, I mean, I think we've touched on a good amount of DeFi, what's going on in broader DeFi, right? But we've haven't necessarily dug into a specific project in a while. And so, I wanted to kind of take this time to dig into one of my personal favorites in the DeFi space, which is Curve. And so I have a few slides here that I can share and kind of take us through, what Curve does and kind of the Curve wars and a lot of the interesting stuff that's happening in that space. Let me
I'm always excited to hear about wars in the crypto space. we got some degens going.
Okay, perfect. I was gonna say, so can you explain Curve for
degens out here going at
perfect.
it.
Oh, absolutely, absolutely. So, I think we touched on Curve a little bit during the whole UST Terra Luna whole crisis, because one of the first red flags was actually discovered if you looked at the Curve pool, right? And you saw the imbalance kind of going on in terms of people getting the hell out of UST, right? And that was one of the first kind of red flags, right? When the peg was slightly breaking, but nothing crazy was happening yet. And then, obviously the rest is history. So just as kind of a, recap for folks that, aren't super familiar, stable coins have been one of the areas in crypto that have really exploded, right? You can kind of see it here on the right hand side in this graph. Since 2019, 2020, stable coins have absolutely taken off in terms of market cap. It's something where you get to realize a lot of the benefits of Web3 in crypto in terms of self-custody and things like that, not having to have your money in a bank account and being able to control all your assets. But at the same time, you don't necessarily need to be exposed to the volatility that a lot of crypto assets have, right? You can still keep your money in a somewhat stable currency that's tied to fiat, to US dollars, right? And the problem with this whole increase in stablecoin market cap and stuff is, there's a ton of stable coins, right? We have USDC, we have DAI, we have Binance's stable coin, we have True USD, we have all these different or USDT, like Tether. We have all these different types of stable coins, and there up until Curve came along, there wasn't a great way to swap them back and forth. The way the mechanisms worked on a lot of the decentralized exchanges that people are familiar with, like Uniswap and SushiSwap and stuff, you would result in, if you were to switch, let's say, USDT for USDC or for DAI or for any other stablecoin, you would end up incurring a ton of slippage, meaning that, let's say I wanted to swap $10,000 of USDC for $10,000 of DAI. When I actually did that swap on a Uniswap or a any other kind of DEX, you'd end up with maybe like 9,500, 9,700, something like that of the coin that you were swapping to. So immediately in this swap, you're losing hundreds of dollars, right? And so that was the real issue that Curve was trying to solve. And so when they came about, they're really a DEX, an automated market maker similar to a Uniswap or something like that, where they've been optimized. They've created their protocol to be optimized for this slippage and for lower fees. So as a trader, you can now go and that same trade for $10,000 of USDC, let's say you're switching it to hopefully $10,000 of USDT, maybe you're only incurring a very slight amount of slippage. Maybe you're going to have 9,995, right? So all of a sudden you go from losing, a ton of money, hundreds of dollars, to losing $5. And that's really kind of the game-changing thing that Curve, kind of introduced. And because of that, they've become one of the most popular, one of the most important, protocols in the DeFi space. They have about 5 billion TVL at the moment. That peaked at around 25 billion back in like the peak of the bear market. And, they have about 75,000 holders.
And really quick, Soham,
yeah.
How do these stable coins kind of gain legitimacy? Like, what type of assets are they backed by to make consumers or investors feel confident having their money in these stable coins?
Yeah, that's a good question. I think, there's really three types of stable coins. There's one that's going to be, fully backed, right? Fully backed with, stable assets. So you could picture a USDC, right? Where in their reserves for every $1 of USDC, they have stable reserves, which are either US dollars or US treasuries backing every single dollar that, is outstanding in USDC. That's one, right? Then we have the, I guess they're collateralized, but collateralized by crypto assets, right? And so something like DAI, which is by MakerDAO, is something like that, right? Where you can then deposit your crypto assets, and you can't, let's say I have $100,000 of Bitcoin, right? If you deposit $100,000 of Bitcoin into MakerDAO, you cannot just withdraw $100,000 of DAI, right? Because since it's a volatile asset, that wouldn't make any sense, right? They give you an LTV cap on how much you can withdraw. So maybe you can only withdraw like 50,000 or 25,000. It's over collateralized, right?
Right.
So you basically submit and put up your crypto assets as collateral. If it falls below a certain level, then you get liquidated and they basically sell your crypto assets, and that's how they maintain the peg.
You can't take the full amount. You've got to take a certain percentage of the amount that you've given them.
Exactly. And then there's a third kind, which everyone is now very wary of after the whole UST situation, is the algorithmic peg, right? Which is not actually backed by anything, but is basically keeping the peg due to arbitrage traders trading back and forth, maintaining that peg. And as we've seen, those can get really big and really successful, but at the same time, in a blink of an eye, can wither away to absolutely nothing. So those are kind of the three types of stable coins. Hopefully, does that kind of answer your question?
That was perfect.
Sweet. All right. So
The only
all right.
other thing I would add there is technically, right, isn't there a fourth category, commodity backed as well, where they can back it with like gold or other precious metals, real estate, things like that, if they really do so, please.
Yeah, I
Not
think
common, but possible.
right. I think as more assets in our real world kind of get tokenized, I think those will definitely become more and more popular. In terms of like the big stable coins today, none of those are technically backed by, you know, quote unquote real world assets. But as, you know, kind of the tokenization of the world continues forward, I expect to see a lot of that for sure.
And that's almost the bull case for stable coins, where we're able to see these other assets come in and establish themselves as ways to stabilize and peg a coin that you could use digitally. So I think that's a great point, Mata.
Absolutely. And I'm definitely looking forward to seeing kind of like, there's going to be a lot of experimentation when it comes to that.
Right.
But, you know, as I was saying, as more and more assets kind of get, you know, digitized and tokenized, we do expect to kind of see that happen.
And not to derail us, but is it Shiba Inu who's coming out with a stable coin now? Do we know if are they algorithmic backed or what's going on? Maybe we don't even know. We don't even have to talk.
I heard Doge might be too. Yeah,
it might be Doge.
It might be
Doge. One of the
yeah,
dog coins. It was one of those. But yeah, you know, interesting with everything that just happened. If they decide to go the algorithmic route, I think there's going to be a lot of people really gun shy on putting their money into something like that. So
yeah, and you know, all of those things, like I think people are starting to realize that one of the products within the crypto space that has gotten serious adoption and is for real and like has a real world use case are these stable coins, right?
right.
And so, you know, you can kind of see a rush into that space with other companies trying to like issue their own stable coins. And this goes like hand in hand with, you know, a bull case for Curve, honestly. You know, it being the, you know, decentralized exchange that is best for stable swaps. And I'll kind of get into, you know, the tokenomics and the incentives and how they've really thought about it in an interesting way and kind of aligned all the incentives to make it a super interesting play in terms of this stable coin kind of market. But just to better understand, like moving forward, like kind of what these incentives are, it also makes sense to kind of first lay out like who are the players in this space, right? Like who are the main customers that Curve is kind of going after. And then after that, it'll make a lot more sense when we go into kind of where the incentives lie and things like that. So I think like the main three customers that you can, you know, tie down to Curve itself are traders, protocols, and then yield farmers and investors, right? So the trader is somebody who's going to come in and say, oh, I have $100 of USDC. I want to swap it for DAI, right? And that's all I care about. All I really care about is this being simple to use. It needs to be fast. Low slippage is very, very important. Like I don't want to be losing a bunch of money, right? On this trade where I'm basically just swapping dollars for dollars, and low fees, right? No one wants to pay a bunch of fees for doing something very trivial. Protocols, and this is where it kind of gets interesting, right? Protocols understand that the only way, like the key ticket to success for a protocol's token is liquidity, right? You're never going to get the big players. You're never going to get the whales. You're never going to get the institutions to adopt your coin and use your coin and trade your coin if there's no liquidity, right? You need to be able to, if you're a big player, get in and out of positions very easily. You need to, you know, be able to, you know, have that liquidity to incentivize people to use the coin, right? That's why you see this, like these like Ponzi shit coins that have no liquidity. It's very hard for them to get off the ground, right? Because like you can really only invest maybe $100, maybe $1,000 into them before you're really moving the price, right? And no big player wants to have to deal with that, right? They also want to offer incentives, right? They want to offer incentives. The way you get, you know, people to provide liquidity for you is offering them incentives, right? Just like any other liquidity provider on any other decentralized exchange.
And
then
so, really quick, sorry to stop the flow there, but
no, you're good.
But liquidity doesn't mean the amount of outstanding tokens there are, right? The liquidity means the amount of people that are willing to come in and be able to offer up, you know, two sides, two different assets as almost like the way where you could swap between, you know, two different coins in this case, right? Like it's not, does it deal with the remaining supply with the amount of tokens that are outstanding, or like what does liquidity mean in this case?
Yeah, not necessarily. The way I think about liquidity is how easy is it or difficult is it to buy or sell your asset? Right. So you can think about liquidity in the stock market. The stock market is like one of the most liquid places, right? Especially for like let's think about like a blue chip stock like Microsoft or something, right? Like it is very easy. If I want to buy however many shares of Microsoft I want to buy, I can go in and just click a button. There's sellers, right? There's always buyers and sellers. So it's very easy to transact. Then you think about a less liquid asset like real estate, right? Real estate, maybe transactions only happen once every, for a house, it could be like once every few years, right? It's a much more illiquid asset, right? So the price discovery is a lot less certain, I guess you could say. It's a lot harder to, if you want to sell your house, you're not going to be able to just go online, click a button and sell your home and immediately. You know, some people are, some companies are working towards that. Then you think about like a super illiquid asset, like a distressed debt bond for some random fucking oil company. Maybe that thing hasn't traded in like years,
decades.
Right. And you might list it and like nobody knows what it's even worth. Right. That's like the heightened point of like illiquid.
Baseball cards, wine, art, it's all that stuff.
And you can think of liquidity in almost any asset class when it comes to like buying and selling. Right. And so in order for a protocol to have its token like truly adopted and truly like, wide ranging, wide scoping, listed on a bunch of different areas, it needs to have a lot of liquidity. You need to have people with the ability to buy and sell it pretty much at will, right? So then the third category is like yield farmers and investors. And these people are just opportunistic people, kind of going in and like trying to make the most of their money, right? They're chasing rewards. They're going after what has the highest rewards. They are, doing the risk reward calculations in their mind to make sure like, what makes sense. On the flip side, they also want to be rewarded in a token that's actually worth something. You think about the issues with the tokenomics behind like a Uniswap or something, right? Uniswap, you go and you provide liquidity. Like let's say you're a yield farmer or something on Uniswap, you're getting a token and the use case for that token is purely governance. And so that's not a good enough use case for people to want to buy the token. So a lot of times what you see in these tokens is the supply keeps going up because they keep having emissions of the token to reward the liquidity providers, but those liquidity providers are just dumping the token. And you see the price just going down.
Right. It's something we saw in NFT collections. I think Garcia has talked about this in the past where it's like this derivative token that comes with owning the NFT and staking it. It's something where it no longer holds a value after that initial, maybe excitement around it.
Exactly. So the yield farmers also want the value in what they're being rewarded in to hold value, right? And so now you kind of see kind of the three main categories of customer segmentation and customer segments that are really at play here. And that'll make sense then, going into kind of the next part. But here's where we kind of get into the tokenomics. And this, it does get a little bit complicated with Curve, but I'm going to try to explain it. So if you have the CRV token, right, there's two ways to really get the CRV token. One, you can just buy it on the market like any other token, or it's a reward for you liquidity providing. So let's say I go in and I have USDC and DAI, right? Two stable coins, and I go and join that pool, right? And I go and put my assets in there. I'm earning the yield, and the yield that I'm earning is in CRV, right? So that's the second way to really, you're getting rewarded in that token, right? Now, you can go then and lock your CRV token, right? You can choose between, I believe it's 1 week and 4 years. You can lock it up for. In return, you're given VECRV, which stands for Vote Escrowed CRV. With this token, you can then use it to vote on where the emissions from the protocol are deviated, which pools, right? So does that kind of make sense? It's a little bit tricky to understand. I like to bring up this like right side graph here, because this is an example of like all the pools, right? These are all different pools in the curve atmosphere. These are different liquidity pools that you can join, right? And this is basically, the pie chart is the total amount of emissions that are going to be rewarded out to liquidity providers, right? And so you can then go and vote, if you have VECRV, on where you want the emissions to go. You can vote on where the rewards go. So you can basically think about, if you accumulate a shit ton of VECRV, you can have a lot of power in terms of where the rewards are going.
Right.
Right.
Two things here.
Yeah.
One, are these guys naming their own pools? Because this is ridiculous in the naming here. Second, the VECRV. Okay. It's obvious. It's similar to STETH, right? Maybe not on the scale of, we're taking down different companies and crypto banks in the sphere, but it's a sense that you're getting a receipt for a token that you've staked.
I feel like VE curve is kind of more like a governance token.
Exactly.
Okay.
Mhm.
Yeah, you're completely right. It's a governance token, right? It enables you to vote on certain initiatives.
But you still get rewards for quote unquote stake. Well, I guess you get that from the stake, right? You get okay. So yeah, it's just a governance token.
There's three main use cases for VECRV, right? So let's say I have some CRV and I lock it up, right? There's three main benefits. One, you got a portion of the trading fees from the protocol. Two, if you are providing liquidity in a pool, that boosts your rewards automatically, right? And the third, which is the most important and what is crucial for what's known as quote unquote the curve wars that we'll go into, is this voting power, right? You can imagine, let's say, look at this big chunk, right? Frax, right? Frax is its own stable coin. It's its own company. It's its own protocol that has its stable coin, right? They want people like the whole success of their Frax token, of their stable coin, hinges on the fact that there's ample liquidity to trade it around, right? How are they going to get people to actually provide liquidity for them? Through increased rewards, right? And so you can see a situation where they want to get a ton of VECRV so they can just own this whole pie chart, right? They want to own as much of this pie chart as possible. Every time there's rewards going out, they want the majority of their rewards, or at least as much as possible, to go to their pool, because that means more people will then come and provide liquidity for them, which helps their token, right? So you kind of start to see this effect, and what interesting tokenomics they have is because they line up a lot of the incentives for the kind of three players in the game. Does that make sense?
So it's kind of like a super PAC, where if you're able to get enough tokens in that sense, your vote's going to mean more, right?
Yep.
You're going to be able to vote and influence the policies that you want.
Exactly.
Very nice.
Exactly. So when you think about it from the demand side too, right? This also solves the issue of like your the CRV token cratering, because now all of a sudden there's like a real use case and a real value behind the token, and protocols want to accumulate a shit ton of it, right? So this goes into kind of what I was talking about with where it aligns the incentives for everybody, right? Protocols are able to, like, they're incentivized to collect as much VECRV, like the votes, as possible, right? And they want to vote to incentivize their own pool, right? Then it goes to yield farmers and stuff. They want to earn high rewards. By getting these rewards, they earn even more rewards, right? Like by joining the pools that have the best rewards, they're doing great on the reward side. At the same time, as I mentioned, the CRV token maintains pretty decent value. So in any other situation, you could sell it, right? But here, you could also just relock it. You could relock your CRV and earn additional yield on it, right? Then there's bribes, which I'm going to get into. This is all part of the curve wars.
I'm interested.
Yeah, the bribes is where it just gets like wild. And then there's the traders who are just benefiting from this entire thing, because with better liquidity, you get better pricing, you get lower slippage, and the entire protocol has low fees, right? So as a trader, you're like, this is great. Like, this is a great user experience. I go in, swap my stables for another stable, and I'm losing like nothing compared to any other DEX I would use, right? So you kind of see this, quote unquote, flywheel effect taking place, where all the incentives end up being aligned for all parties involved.
Which is a business model that, I mean, Warren Buffett backs. Like, that's something, when you're able to create a flywheel effect in business, that's something where all incentives are aligned, and the idea of the wheel gaining speed and only getting faster, more people getting more profits along the way, is hugely incentivized by every party and creates a very successful business. So you can see why Curve is able to create this large user base and also house this large amount of capital, because all these incentives are very well aligned between the different customer segments that you've talked about.
Exactly. Couldn't have said it better myself. And then this is where we get to the curve wars. So the concept of bribes. What you can actually do is protocols can, okay, so in any war, right? There's quote unquote mercenaries. They're not loyal to anybody. They just go to whoever just pays them the most.
Guns for hire.
Right? Exactly. So it's pretty much the similar concept here, where you have a bunch of people who have a bunch of VECRV, and they don't care they don't have any like stake in the game in terms of what pools this is going to, right? And so what you have is a situation where protocols are actually able to bribe holders of VECRV and say, okay, if you vote to deviate rewards to my pool, I am going to give you some money, right? And so this is the other aspect of VECRV, which is really interesting. So even as a smaller player in the game, we're like, sure, like if I vote for this pool, if I vote for that pool, that doesn't do that much for me, right? Personally, as like a small player. But now, some huge protocol actually cares where my votes go, because they're trying to get as much VECRV votes in their pool as possible. And so that's where the concept of bribing comes in, which has become huge. I mean, like massive players have been bribing with hundreds of thousands, millions of dollars to get people to vote for their protocol, because for them, it's a good trade,
Right.
If they can pay $1 in bribes to then get multiple dollars worth of, revenue on their protocol, it's a good trade for them, right?
And when we're talking about multiple dollars in revenue, I guess, Zoe, do you have any idea around the magnitude that we're talking about? Is it like how lucrative is this opportunity?
It's a good question. I think in the articles I read, it was in the tune of maybe like spend $1 in bribes to get like maybe in between like $1.50 and $4 or $3.
Okay. So definitely
So
worth it.
That's really
Yeah.
good.
Yeah. So that may have changed, because I remember reading that like quite some time ago, but that was the trade that I remember kind of reading about from the protocol side, which obviously makes sense, right?
Right.
Obviously, it helps the adoption of whatever coin you have and stuff like that. So lastly, like who are the main players in the kind of curve wars? And this can go even way deeper because the whole convex stuff gets even more crazy. So we could probably do another whole like segment on convex and their role in the curve wars. But basically what convex is set up as is a protocol where their sole goal is to gain as much voting power as humanly possible, right? And so what they set up as is a way to, for smaller players who don't really care about all this, the war kind of going on and only care about yield. These are the people that convex kind of attracts. And so what you can do is you can basically give them your CRV, right? You give it to them. It's gone, right? At the same time, you receive a receipt, which is one of their convex tokens that says, okay, I've deposited curve with convex. What they do is they pass on the trading fees and they pass on the yield that's generated from the CRV or VECRV, right? As we kind of talked about before, they pass that on to you as a user, and they also tack on their own token, which is CVX. So you basically earn the yield that you were going to earn anyway, and you earned a little bit on top with the CVX token. But what you forfeit is the governance rights. The governance rights goes all to them. All the voting mechanisms, all the voting power that you have is then forfeited to convex. So for people who just care about the yield, that's why convex has been very, very successful. They've been able to accumulate a metric shit ton of VECRV because people just give it to them. They pass through the rewards and the trading fees and all that. They tack on a little CVX on top of their own token, but then they just have a colossal amount of voting power where they can deviate the emissions where they want to deviate them to. Yearn Finance is another one. It's a yield aggregator.
Really quickly, so
what's up?
On convex. So when you lock up your VCRV with convex, gives them the governing rights. They then give you just a CVX token that says that you've locked this up, or do you still own the VCRV? Do you see what I'm saying? Like
you don't own the VCRV
is
anymore.
CVX okay? So CVX just tracks with the VCRV price point. Then is that
yeah, you're exactly right. You're exactly right. It's not the CVX. That's not the CVX token. The receipt they give you, I think, is called CRV CVX.
Okay.
And this is where it just gets like kind of foggy in my head.
Just derivatives.
Yeah,
That's all it
exactly.
Yeah.
But Armada, you're completely right. It tracks one for one with VECRV. Right.
Cool. Just want to clear that up.
Yeah, no, exactly. You got it exactly right.
That makes sense.
And then, Yearn is another, big one. Everyone, you guys have all heard of Yearn. They're like a yield aggregator. You lend them your tokens, they go and manage the yield. They pass it through to you, take a little bit of a cut. They're also the reason why they're able to offer really good, rates when you deposit with them is because they own a lot of the VECRV and they're using it to farm. Right. And so it's in their best interest to accumulate a bunch of this. Right. So they're another huge player in the game. And then, as I kind of mentioned, these
well,
stable coins.
It's a question, Zoe, of do they only own are all their assets within the Curve protocol? Like, can you? Yeah, Yearn.
No, not all of them.
Right. So the return that they're guaranteeing isn't based on like the Curve trust and the Curve resiliency that we've seen in the last couple of years. There's a couple other protocols that they're basing their fees on. Their
fees or their like returns?
Sorry, returns on. Fees are probably where they're getting their returns.
Yeah, as a protocol, they probably charge some sort of fee as like an aggregator. They probably take a fee from on top. But yeah, like they have multiple different strategies going on, when you deposit with them, how to like best optimize for the best yield.
Right.
It's not just in Curve. but probably like a lot of the stablecoin yields that you see on Yearn are coming from, you know, some relationship with Curve at some way, shape, or form.
Right. Makes sense.
And then, you know, we have the kind of the stablecoin issuers that I was mentioning earlier, Frax being one of them, Abracadabra with MIM being another one. They've notoriously been huge bribers, like huge, you know, they've devoted a lot of money to just bribing people to basically go and like, cause they want their stablecoin MIM to take off. Right. Which,
Right.
you know, for a while it did. Currently, you know, it's still hanging around. So, you know, a big part of that, especially if you're launching a stable coin, is like managing that, managing your curve strategy and managing to, you know, devote a certain amount of money basically in customer acquisition cost, if you will, because you're basically incentivizing liquidity providers, which then flywheels into people using your stable coin even more. So yeah, that's pretty much all I had on this whole thing. Hopefully, you know, you guys and the listeners kind of found any of that useful and stuff. But easily one of my favorite kind of stories within the DeFi realm to keep track of, keep a pulse on. Super interesting stuff, and I just love the way they've organized their tokenomics. Like, it's easily, I think, the smartest tokenomics that I've seen.
I was going to say that this seems more well thought out than a lot of the other projects we've discussed, and especially a lot of these other basically exchanges and aggregators that are counting on people dumping a bunch of liquidity into the pool and then going ahead and leveraging that to basically get that APY for the people that stake their stable coins or their actual crypto. Whereas this, like to Evan's point, the purpose of this is to create a flywheel where basically if the right mechanisms are in place, they can just kind of take their hands off and everyone's benefiting from some way, shape, or form throughout the entire ecosystem. So that was a fantastic breakdown.
Yeah, absolutely fantastic. And I think one thing to note with Curve, like you're saying, Zoe, is that the founder of this, I forget his name, but he's a very well established technologist. I believe he was the head of a division at LinkedIn, won a bronze medal in an Olympiad event. You know, there's certain people in crypto that you just realize how smart they are, you know, and it's like you only come upon this once you realize the inventions that they've been able to create, probably in the DeFi space. And this is one of those. I mean, this is very well thought out. All incentives are aligned. And there's a reason that it's been very successful, even through the UST collapse, which I think we can all agree was probably the biggest collapse we've seen in crypto in the last year. So it's something to say about the resiliency and the architecture of what they've been able to put together here on Curve.
No doubt.
Definitely super incredible. But I mean, I just can't help but think, like, when we were going through Terra Luna and everything with that, like, we just kept saying, yeah, I mean, this is pretty incredible as well. So it's got me kind of like thinking, like, okay, this is super cool. Love the background. Super well explained. Where are the holes, right? Like, what's gonna drop and they're not gonna be able to plug it, right? And the only thing that I'm thinking of right now is, like, with those kind of three main players that you covered, is that would it ever get to a point where someone would have so much governance that it would just kind of defeat the entire purpose? Or kind of where do you see this going from here? Are there going to be any sort of clampdowns, or I don't want to say like regulations, but like things that they put in place in order to get ahead of stuff like that happening? Or kind of what are your thoughts there?
Yeah, no, that's a good question. I mean, at this point, I think like Convex is I'm trying to find the graph. I don't think I have it on me, but Convex has accumulated like a really large portion of VECRV.
And I assume Curve wouldn't want that, right? Because then that would kind of ruin that cycle that they had going, that flywheel that we were talking about.
Right. It misaligns incentives.
It's worth noting that, like, I mean, you guys saw the gauge weight like pie chart, right? Like, unless somebody owns 100%, they're not going to be able to deviate 100% of the emissions.
51% wouldn't be the number that you're looking for here.
No, because then, I mean, they could deviate half the emissions.
I thought it'd be 51 too. That was my
Yeah.
Because
my-
it's not
That
a,
was-
it's
yeah,
not
that
a,
was
it's
why I
not
was
a,
off base.
it's not a end, it's not a like one, like majority takes all. It's like how they like, it's like a proportion of the total votes. Right. So
So
you have a
would- so
pool,
wouldn't
you
it
have
be
a pool
similar
of,
to, like,
you have a
the-
pool of rewards that go out like every, I don't know how often they go out, maybe like once every couple of weeks, once a month or something. Right. And so you have a pool of rewards, and then you have votes from like everyone, right? But it's not like if you got over 51%, you could deviate all the votes one place.
Mm.
You could just
Like
control
allocations.
that. You could just control 51% of the votes, and you could deviate them to one thing if you wanted. But all those other pools will still have people voting for them. So like, let's say there's like $100 of rewards, right? If you had 51% control, you would only have control over $51 of rewards. But there's another 49% that everyone else could potentially like vote on and you know, deviate however they want.
Are these votes not majority? Like in the sense that you could make changes to how allocations are divvied out? You know, could that 51% not play a major difference in that vote? When you think about, you know, ERC votes, basically like being able to make sure that like Ethereum, you know, requests are voted upon correctly, right? Wouldn't you think that 51% could be a big difference maker in how the Ethereum protocol and network works?
But you're saying if like other things besides just the rewards,
Right.
like just like the governance of the overall protocol.
Exactly. Yeah.
Yeah, that's actually fair.
Because I think
I'm
that's a
not
real
sure.
point. Yeah, I
Yeah.
think that's a real point, but it's something that there's like, you know, hopefully stoppers before that happens,
Yeah,
because
that was kind of the question. And I
Right.
don't know if we
Yeah.
even know that. That's something
Yeah,
we can,
because,
we
like-
can come back to.
Yeah, because my mind goes directly to like Luna Crash and then Solend, where it was like that entire DeFi protocol almost went under if they weren't able to get out to that specific user of that particular wallet. So it's like, what would happen if there was like an erroneous vote and someone just basically was, you know, fucking with the system, and they had 51% of the vote, they had enough tokens to allocate that much, and then all of a sudden you have that entire area of curve like having an issue, I guess is my kind of, that's where my head was going.
Yeah. No, I think that's definitely fair. I'm gonna try to look into it.
Yeah, if
Yeah.
you trust
I
and
think-
integrity of your big players and your whales in that space at that point, which then Curve would have no control over. So that's why I was curious if there was anything like put in place, any stoppers or anything like that. But
No, it's a very
Yeah.
good point. It's a very good
I
point.
think we do a part
It-
2 on
it-
this because this is super interesting.
I
Yeah,
think
this is
so.
really-
I think so. Yeah.
Let us know in the comments. Let us know in the comments.
Yeah, absolutely.
Curve horse, curve horse.
Well, and I think another point on Curve too is kind of my terrible transition that I have from our macro to Curve here, was talking about the same like assets. Like the whole idea around Curve is same like assets. The reason you're able to trade stable coins so well on Curve is because they're same like assets. When you look at other wrapped currencies like a wrapped Bitcoin, or I believe there's other, I don't know if you'd call them derivatives or what you would call it. There's other ways that you can create like assets in the sense of Bitcoin and probably Ethereum once it's established itself more. The Curve is something where you kind of consider it an industry standard because it doesn't play a different, like it plays the same role technically in the ecosystem as a Uniswap, as a Sushi Swap. Like it is a DEX in providing liquidity, but they've got different rules around that. And so they've got great rules in the sense that they're providing liquidity to the same like assets. But right, there's further questions that need to be ironed out around the governance of these like very strategic protocols that we have. And sorry to go on a rant there.
No,
Given
no,
the
I think
background that you gave Evan
yeah.
as well, I bet you there's some pretty well thought out and built out white
Mhm.
papers and light papers out there that we can dive into. So, yeah.
Oh, I think
Sorry,
it,
Sam, what were you saying?
it just brings up a broader question. I think we could probably end on this because it is a very broad question. I don't think anybody has figured it out within the crypto space
Yeah.
at all, which is how do we handle like decentralized governance like into perpetuity, right? Like, is it like it's easy to see how some of these decentralized governance mechanisms may work for like a short period of time, but can fall apart if certain like things like happen, right? And so that's like something as just a broader, Web3 community that I think like a lot of people need to do a lot of work on is like, how do we solve these problems not only in like the short term in the question of decentralized governance, but how do we make like a sustainable solution that will actually last for a long time?
Well, it's something that a lot of emerging countries have still yet to figure out. It's not something that's, I mean, pull it back to the Sri Lanka point that we had earlier today. Like it's something where this is, not only in the crypto sphere, but also just in the geopolitical sphere that like we see every day. So yeah, I think it's a great point.
All right, boys. Well, I think that'll do it for this week. To the listeners, hopefully you guys found some of this useful. If you liked it, make sure to like, subscribe, and comment down below. We'll obviously be back same time, same place next week. Great episode today, and looking forward to running it back for episode 21 next week. So thanks again, and wag me.
20 in the books, fellas. Love it.
Peace.
See everybody next week.
2-0.